Most people believe the US government collects taxes, spends that money, and prints dollars when needed. That's the simple version. But it's not how things actually work. The truth is far stranger. The government doesn't need to have money before it spends. It creates it, not by printing cash, but by typing numbers into a computer. It creates money from nothing. This process fuels everything from stimulus checks to trillion-dollar bailouts, from infrastructure spending to military budgets, and yet most Americans don't know how it happens or what it means. How does the US government create money? Who controls that process? And what happens when the system goes too far? To understand the future, we have to understand how we got here. The United States was founded by men who distrusted centralized financial power. They had just fought a war against the British Empire and its powerful central bank. They didn't want to replace one empire with another. In the early years, money came in many forms: gold and silver coins, paper notes issued by private banks, and even tobacco or livestock in barter transactions. There was no single national currency. The result was chaos. In 1791, Alexander Hamilton proposed the first bank of the United States to stabilize the young country's finances. It acted like a central bank, issuing currency and managing public credit, but its charter expired in 1811. The second Bank of the United States followed in 1816, but it didn't last either. In 1836, President Andrew Jackson vetoed its recharter. He believed centralized banking was a threat to liberty. For the next 77 years, there was no US central bank. Money was controlled by private banks, backed by gold, and regulated unevenly across states. But the system couldn't handle crisis. Panics and bank runs were common. In 1907, a major financial panic nearly collapsed the entire US banking system. Private bankers, including J.P. Morgan, had to coordinate a bailout themselves. It became clear that the country needed a centralized institution to manage the economy. In 1913, Congress passed the Federal Reserve Act. The Federal Reserve, or the Fed, became the US central bank. Its job was to stabilize prices, regulate banks, and act as a lender of last resort. At the time, the US dollar was still backed by gold. That meant every dollar could be converted into a specific amount of gold, limiting how much money could be created. That system would not last. The Great Depression changed everything. In 1933, President Franklin D. Roosevelt banned Americans from owning gold. Citizens were required to turn in their gold to the government in exchange for paper dollars. This wasn't just an economic decision. It was a turning point. It allowed the government to control the money supply without being tied to gold. In 1971, President Richard Nixon took the final step. He ended the convertibility of dollars into gold for foreign governments. The dollar became a purely fiat currency, meaning it was backed by nothing but trust. From that point on, the US government could create money at will. Here's the truth: the government doesn't need to print money to create it, and it doesn't need tax revenue to spend. The process works in two main ways. One, the Federal Reserve creates money digitally. The Fed doesn't just print physical dollars. It creates digital money by buying assets like government bonds or mortgage-backed securities. Here's how it works. The Fed buys a bond from a bank. Instead of paying with cash, it simply increases the bank's reserve account at the Fed. The money didn't come from anywhere. It was created with a keystroke. This is called open market operations. It's how the Fed injects money into the financial system. During the 2008 financial crisis, the Fed used this tool to stabilize banks. In 2020, during the COVID-19 pandemic, it used the same method to create over $3 trillion in a few months. 2. Commercial banks create money through lending. When you take out a loan, the bank doesn't hand you someone else's deposit. It creates a deposit in your account. New money appears. Banks don't lend out reserves or physical cash. They create new money when they approve loans. This is how most money in the economy is created. Together, the Fed and commercial banks form the engine that creates modern money. Money creation allows the government and financial system to respond to crises. But there are limits. Too much money can cause inflation, distort markets, and create instability. The 1970s, stagflation, After leaving the gold standard, the US faced high inflation combined with stagnant growth. Energy prices soared, unemployment rose, people lost purchasing power. It took massive interest rate hikes by Fed Chair Paul Volcker, over 20%, to bring inflation down. The move caused a deep recession but restored price stability. 2008, the financial crisis and quantitative easing, loose lending standards and speculative bubbles led to a global financial collapse. The Fed created trillions in new money to buy toxic assets and stabilize the system. This saved the banks, but widened inequality. Stock prices surged, Wall Street recovered, Main Street didn't. 2020, pandemic stimulus and new surges. To avoid a depression during the COVID lockdowns, Congress passed trillions in stimulus. The Fed added trillions more through asset purchases. The economy rebounded faster than expected. But by 2021, inflation spiked. Prices rose faster than wages. Supply chains buckled. Creating money saved the economy, but created new problems. Every time a crisis emerges, the solution is the same. Lower interest rates, inject liquidity, create money. But each fix builds new risks. Debt grows faster than income. The national debt is now over $34 trillion. Annual interest payments are approaching $1 trillion. The government borrows to pay for everything, from wars to healthcare to tax cuts. And much of that debt is financed by the Fed's money creation. Inequality rises. When new money enters the system, it flows first to banks, investors, and large institutions. Asset prices rise. Stocks, real estate, collectibles. Those who already own assets gain wealth. Those who don't fall further behind. Bubbles form and burst. Cheap money encourages speculation. It drives investment into riskier and riskier bets. When reality catches up, markets crash. Then the cycle begins again. The result is an unstable system, propped up by money creation, but increasingly fragile. Today, we're seeing the results of decades of monetary expansion. 1. The US dollar faces. Global competition nations are exploring alternatives to the dollar for trade. Countries like China and Russia are promoting other currencies to bypass US sanctions and reduce reliance on American finance. If global demand for dollars falls, the US may struggle to finance its deficits. 2. Persistent inflation and rising costs. Even as the Fed raises rates, key costs remain high. Housing, healthcare, insurance, education. The trillions created during the pandemic still circulate, keeping upward pressure on prices. 3. Record levels of consumer debt. Americans now hold more than $1.3 trillion in credit card debt. Student loans and car payments are rising. As interest rates climb, so does the cost of debt. 4. A broken wealth ladder. The top 10% hold over 70% of all US wealth. Most Americans live paycheck to paycheck, with little access to the assets inflated by years of easy money. These trends are not isolated. They are direct results of how money is created and who receives it first. Lesson 1. Modern money is based on trust, not value. There is no gold backing the dollar. Its value comes from collective belief in the US government's ability to manage the economy. That belief is the foundation of everything. Lesson 2. We can't print our way to prosperity. Creating money can solve short-term problems, but over time it builds imbalances that threaten stability. Debt-fueled growth is not a permanent solution. Lesson 3. Every solution has a cost. Bailouts, stimulus, and cheap credit carry long-term consequences. The benefits are immediate. The costs are delayed, but they always arrive. The US government creates money through a system few people understand. It has become normal to borrow trillions, stimulate markets, and assume the dollar's dominance will last forever. But the more money is created, the more fragile the system becomes. Each crisis demands more intervention. Each fix pushes us closer to the edge. The question is no longer whether the government can create money. It's what happens when the world no longer believes in it. If you found this breakdown helpful, share it. Most people have never been told how money really works. They deserve to know. For more in-depth explanations of how modern systems function, and sometimes fail, subscribe and stay informed. Because in a world built on belief, knowledge is your strongest currency.